Your $20,000 could pay you $500 weekly. Your account sits idle, no income. You feel stuck. This isn't your fault. You take a painful loss. 2 weeks later, same mistake. The cycle repeats. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Now imagine a repeatable options strategy paying you weekly. No more idle accounts. This is your new rhythm. Results aren't guaranteed. This is education only. But one mistake destroys 90% of beginners. I'll show you how to avoid it. Here's the twist nobody tells you about weekly income. It's never going to be sexy. You've been sold a lie that wealth comes from one genius prediction. The real money, the consistent income that stacks up paycheck after paycheck, is built on a foundation of high-probability singles. The psychological trap is mistaking a home run swing for a valid strategy. You see a large, fast move, and your brain screams that you missed it. So you take a massive, leverage-saturated position trying to force the next one, and the dopamine hit feels like clarity. But that addiction to high-risk trades is a liar. It tricks you into believing intensity equals intelligence. There's a reason Wall Street pros sleep soundly while retail traders panic at 3 a.m. It isn't because they have bigger accounts. It's because they've separated speculation from income generation. A speculator bets on a stock's direction. An income generator sells probability. You've been trying to predict the future, a game you can never win consistently. The shift happens when you stop trying to guess where the ball will land and start calculating the odds of it landing anywhere but a specific spot. It's the difference between buying a lottery ticket and owning the lottery. When you own the lottery, you don't care who wins. You just collect the premium from every ticket sold. The strategy I'm about to show you flips this entire mindset. It doesn't rely on you being a prophet. It relies on you being a statistician. You don't need to be right about a stock's direction. You just need to be right about where it probably won't go. This eliminates the paralysis of analysis. There's no staring at 20 indicators, praying for a signal. It's a cold, systematic process that makes the market boring again. You stop being a victim of the chart and become a seller of time. Imagine waking up knowing your money worked overnight. Not in a frantic, "I hope the market doesn't crash" way, but with the quiet certainty that time passed, and that passage created profit. The anxiety vanishes because you defined the risk before you took the trade. The overnight session becomes your employee, not your torturer. This is the foundation of options income. You are not a trader dodging bullets in a battlefield. You are the insurance company, calmly collecting premiums while the world spins, understanding clearly where the real edge lies. Forget everything that confused you about options. We're keeping this simple. Here's where it gets interesting. You can be the seller, not just the buyer. Most people spend their entire lives only buying options, watching their money drain away. You know the feeling. You buy a call, the stock barely moves, and your money vanishes by Friday. That's a rigged game. Now flip the script. You become the landlord collecting rent every single week. Instead of paying for insurance, you're the one selling it. When you sell a put option, you promise to buy a stock you already want, but only at a lower price. For that promise, someone pays you cash immediately. You don't need the stock to skyrocket. You just need it to not crash. You walk onto the trading floor not as a gambler but as the house. The house collects rent. The house wins over time. What if time decay worked for you instead of against you? You know that sickening feeling when you're long an option and the clock hits 3:59 p.m. on expiration day. Every second steals value from your contract. That's theta. For a buyer, theta is a silent predator, eroding your account while you chase a moving target. But when you sell an option, theta becomes your quiet employee, depositing cash into your account as you sleep. You don't need to be good at predicting the future. You just need to be good at letting time pass. Every night you go to bed, decay chips away at the buyer's hope and transfers their cash to your pocket. It's a probability game. The odds aren't 50-50. They heavily favor the seller because a stock must hit a specific target in a specific time. You just need it to stay flat or drift. Stop. This next part is where most people get greedy and lose. You'll be tempted to sell what's called a naked option. The potential gains feel unlimited, but the risk is a bottomless void you cannot see. That's undefined risk. One black swan event, one surprise crash, and your $20,000 account isn't just hurt, it's wiped out and you owe more. That's the trap. You must contain the beast. You do this by defining your risk before you enter every trade. You sell a spread by buying a cheaper option further out, a safety net. It costs a small bit of your rent, but it ensures you never face a margin call. You are trading precision, not leverage. Defined risk keeps you in the game. This is the moment. The exact strategy stripped bare. No theory, no noise. You've been on a roller coaster of hope and pain, chasing a big score that never comes. That stops now. The method that generates a calm, repeatable weekly income is the combination of the cash-secured put and the wheel strategy. It doesn't require you to predict the next meme coin. It requires you to become an insurer. You will sell a promise to buy a quality company's stock if it dips to a price you choose, and you collect a premium up front for making that promise. The market pays you in cash, deposited into your account the moment you place the trade. You're not a gambler chasing price. You're the casino offering a contract, and you start with a statistical edge. What happens if the stock drops? I'll show you why the thing you fear is actually the engine of wealth. This is where the wheel completes the loop of the money machine. Let's say the market does dip, and you are assigned the shares at $47.50. The rookie trader panics. The systematic premium collector smiles. You now own 100 shares of a company you wanted anyway, and your cost basis is immediately lowered by the $50 premium you already pocketed. Now the cycle reverses. You turn around and sell a call option against your shares. You collect a second premium from a buyer hoping the stock rebounds. You get paid to buy at a discount, then paid to sell at a premium. It's an airtight cycle, where price fluctuation is irrelevant to your income production. It's a money machine on a loop, a flywheel of liquidity. The wheel neutralizes the noise. You collect premium for the put. If not assigned, you repeat immediately. If assigned, you collect premium for the call. You get paid while waiting and paid again to sell. This mechanical sequence shatters the emotional paralysis caused by a red candle. The stroke of genius lies in the expiration cycle. By targeting weekly expirations, you compress time. Instead of waiting a month for a single payday, you create a weekly income stream. An $8,000 capital allocation targeting a modest 1% weekly return on that tranche creates a physical, tangible payday every 5 trading days. You are no longer staring at a volatile equity curve. You are collecting a paycheck. There's a specific reason we choose certain stocks. Get this wrong and the mathematical edge collapses instantly. You are not buying volatility. You are selling it. The stock must be a stable, liquid titan that you would proudly own for a decade. Think of the companies whose products you use daily, whose balance sheets are fortresses. If you chase a high-premium, no-name biotech stock just because the yield looks juicy, you will catch a falling knife. The premium is high for a reason. The risk of collapse is real. We only sell puts on stocks where a dip is a gift, not a bankruptcy. Your edge isn't just the premium. It's the underlying asset's refusal to go to zero. A strategy without risk management is a time bomb. One bad trade can erase weeks of patient work. You know the feeling, watching a position turn against you, powerless because you overcommitted. That panic isn't your fault. It's a predictable consequence of poor sizing. Never deploy your entire $20,000 at once. Never. Position sizing is your shield. Think of each trade as a single soldier in an army. If one falls, the war isn't lost. This isn't about fear, it's about survival. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You protect the account first, profit second. Here's the rule that separates survivors from blown accounts. When a trade moves against you, assignment isn't the end, it's a transition. If you sold a put and get assigned shares, you now own quality stock at a discount. That's the reframe. Losing trades happen, they're tuition for the market's lessons. The key is to handle them without emotion. You can roll options, closing the current position and opening a new one with a later expiration or different strike, to buy time and reduce cost basis. This isn't hoping. It's a calculated adjustment. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You manage, you don't panic. Skilled traders treat a loser like a live wire, handle it with care, then move on. There's a defensive move pros use that beginners never learn. Keep a cash reserve, at least 30% of your account, liquid and ready. This is oxygen. When volatility spikes, cash lets you adjust, double down wisely, or meet margin calls without forced liquidation. Over-leveraging is the silent account killer. It feels like efficiency but rots discipline. And here's a truth you won't hear in hype videos. Take profits early. A bird in hand beats a full loss later. When a position hits 50 to 70% of max profit, consider closing. Greed whispers more, but discipline locks in gains. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You're not chasing every dollar. You're harvesting them systematically. Stop chasing every premium. Greed is the silent killer here. Avoid earnings dates, binary events, and low-float stocks that whip on no news. High volatility traps masquerade as opportunity but shred accounts. Your edge lies in steady, repeatable income, not gambling on announcements. Before you place a single trade, commit to your future self. Hit like, subscribe, and comment trading below. This is your public accountability to disciplined trading. In the description, you'll find 2 free gifts: the 15-step checklist to use before every trade, and a risk management calculator to never risk too much again. These tools will skyrocket your weekly income consistency and keep your $20,000 protected. Now let's see this in action with a real week of trading. Tuesday morning, you execute. Scanning is done. You know the stocks, the strikes, the risk. You sell cash-secured puts on 3 positions. High open interest, out of the money, 30 days out. The orders fill fast. Credits flash on your screen. $175, $130, $95, $400 of instant premium. You used to lose that much chasing breakouts. Now, income flows in. You feel the old urge to trade more scratching at you. You pause. Stillness creates clarity. Clarity creates discipline. Discipline keeps you green. You close the laptop by 10:30 a.m. The market keeps moving, but you're unattached. You've sold time decay, not your emotional energy. The premium is yours, the risk is defined. Tuesday ends with you living your life, not staring at charts. But Wednesday is when things got interesting. The real skill isn't entry, it's management. Wednesday will test your nerve. Friday arrives, expiration day. 2 puts expired, worthless, $310 premium pocketed. The third you close Tuesday for $90. Weekly total, $500. No adrenaline, no midnight stress. Just calm execution. The income feels almost boring, and that's perfect. You're not chasing dopamine, you're running a system. But what about the weeks it doesn't work? Last month, a stock gapped below your put strike. You were assigned shares. Your gut screamed to dump them at a loss. But you followed the plan. Sell covered calls against the position. You collected rent while waiting for recovery. That week, you broke even. No gain, no loss, but no damage. Consistency isn't about winning every week. It's about never letting a loss spiral. You breathe. Stillness creates resilience. Resilience creates longevity. Small losses controlled. No catastrophic drawdowns, just steady execution. That's the edge. This weekly rhythm becomes your new normal. Scanning, selling, managing, expiring, it repeats. The system works only if you work on your mind. Without discipline, you'll overtrade. Without patience, you'll panic. Without stillness, you'll self-destruct. The market doesn't destroy accounts, your emotions do. 20 minutes of effort, $500 income. Yet most traders can't follow it. They chase excitement, not execution. You're different. You felt stillness. This routine becomes second nature, but only if you master your mind. Stillness creates discipline. Discipline creates consistency. Consistency creates wealth. It begins with the mind. That's what we'll train next. The inner game. Without mastering the inner game, even this strategy fails. But lock in your mental edge and income flows without resistance. You become the calm in the storm. The market moves, you don't. Master your psychology. That's the real transformation. Here's the psychological glitch costing traders thousands. Your brain cannot tell the difference between a real threat and a drawdown. A red candle triggers the same ancient fight or flight response as a charging predator. So you flee the trade to feel safe. You must learn to see a red candle not as danger, but as a noisy data point within your predetermined risk. The fear fades when you stop fighting for survival and start executing a plan. After a loss, the demon of revenge trading whispers in your ear. It tells you that you're a victim, that you need to get back to even immediately. You throw your rules away and double your size. This is not trading, it's a tantrum. You are throwing money at the screen to soothe your ego, and the market will happily take it. The first rule after a loss is to step away. The market will still be there after you've regained your composure. There's a mental shift that transforms anxiety into confidence. You've been living and dying with each trade, treating it like a verdict on your intelligence. The shift is detaching your identity from any single outcome. A win doesn't make you a genius, and a loss doesn't make you a fool. You are simply the operator of a system that produces a distribution of wins and losses over time. Your only job is to pull the lever with consistency. Your weekly income depends on this one habit more than any indicator. You must treat your trade journal like a sacred medical record. It's not a diary of your wins, it's a ledger of your symptoms. You write down not just the setup but the feeling in your stomach. Did you follow the rule? Was there hesitation? Over weeks, this journal reveals a map of your own psychological landmines, showing you exactly where your process fractures under pressure. Mistake 1 is over-leveraging. You treat every trade like it's the last one on earth. You size up too big and a small move against you feels like a knockout punch. You're not trading, you're gambling your recovery. When you use too much capital, your judgment freezes. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Without discipline, the position sizes you. The second mistake feels harmless until it's not. You chase high premiums on garbage stocks. You see a yield that looks like free money and your brain ignores the danger. It's a yield trap. That massive premium exists because the market knows something you don't. The underlying asset is a falling knife. High premium almost always equals high probability of implosion. You're picking up pennies in front of a steamroller, and the quiet hum sounds safe right until it flattens your account. Mistake 5 is the silent killer. You abandon the entire strategy after one bad week. You take a painful loss, and 2 weeks later, you make the exact same mistake because you jumped ship. You chase a new shiny indicator, a new guru, a new hope. But the problem was never the plan. The problem was your patience. Consistency compounds. Hopping resets you to zero. You don't need a better strategy. You need a longer fuse. Now imagine compounding this strategy over a full year. Not a week of frenzied bets, but 52 weeks of cold, calculated, consistent execution. No blown accounts, no midnight panic. Just a quiet, growing equity curve that rewards your patience. When you remove the 5 deadly mistakes, you don't just save money, you buy back your peace of mind. And that peace is what lets you finally scale, because you're no longer bailing water out of a sinking ship. Start with $20,000. At $500 a week, that's 2.5% weekly. With compounding, that $20,000 becomes $28,000 in a few months. Soon you're earning $700 a week, then $1,000. You're not trading more, you're letting the method scale. Each cycle adds another layer. Your risk management stays the same. Your discipline deepens. Growth creates clarity. Clarity creates consistency. Consistency creates compounding. The snowball picks up speed. You reach $1,000 a week. That's $4,000 a month. What would an extra $2,000 a month do for your life? Pay off debt, save for freedom. The market doesn't care about your hopes, it rewards systems. Your system is designed for this. You didn't stumble into success. You built it trade by trade. The math is inevitable. You just let it work. That income buys freedom. Freedom builds your life. The process doesn't change. Now when to add capital? Not yet. Let compounding do its work. Most traders sabotage by throwing more cash in too early. You don't need more ammo, you need more time in the trenches. Your system proves itself. Then when your account has doubled, you can add carefully. Diversify strategies as you grow. Maybe sell calls on quality stocks. Maybe sell puts on indexes. You're not overcomplicating, you're reinforcing. The method expands. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Discipline creates diversification. There's a tipping point where your money outturns your job. Your trading income surpasses your salary. You're no longer trading for bills, you're trading for legacy. You allow growth, you don't force it. Diversification is layering edges. The math snowballs. Your account earns while you sleep. The tipping point arrives. Your job becomes optional. This is your reality. You're planting a tree that pays dividends every season. Week by week, trade by trade, you're building an orchard. Financial independence isn't a dream. It's a math problem solved with discipline. Your trading now funds your life. You don't answer to a boss. You answer to your system. The market becomes your employee. It works while you live. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Discipline creates freedom. The tree grows deeper roots. You water it with consistency. You prune it with risk management. You harvest it with scaling. The dividends flow. This isn't a side hustle. It's a business. Your business, built on a method that never changes. You just execute. The vision is real if your process is real. You're not waiting for luck. You follow a blueprint. Financial independence means choice. You choose your time, its power. Let me leave you with the one thing that determines your success. It's not intelligence, not luck. It's not even strategy. It's your ability to stay consistent when the market shifts. Bull markets make you feel invincible. Bear markets test your mettle. Your method works in both if you let it. You don't adjust your rules, you adjust your expectations. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Discipline creates sustainability. You build a trading business that lasts years, not weeks. Through volatility, through drawdowns, through boredom, you execute. The method doesn't change. The market does. You stay consistent. That's the edge. You don't need to predict markets. You predict your response. The system handles the rest. Consistency is a practice, not a trait. That practice builds your business. That business builds your freedom. Now let's see how it all fits. Here's what separates the dreamers from the doers. The doer takes one small, disciplined step today. Open a paper trading account. Execute the plan without real money. Let your mind learn the rhythm before your capital is on the line. This is not a game of instant riches. You must understand, this is an educational journey, not a promise of overnight wealth. Past performance never guarantees future results. You control the risk, not the outcome. Remember, this is a marathon of consistency, not a lottery ticket. Every trade you manage is a brick. Brick by brick, you build a financial future that doesn't depend on a boss or a clock. You're not chasing a rush. You're engineering a quiet, steady income stream that compounds over time. Now I need you to do something. If you're serious about applying this, hit like, subscribe, and type trading in the comments. Type that word as a personal commitment, an accountability pact with yourself. You're not just watching another video. You're declaring that you'll start. And to make sure you start right, check the description for 2 free gifts: the 15-step checklist to use before every trade and the risk management calculator. These tools aren't optional extras. They're your guardrails. The checklist will freeze your impulsive mistakes before they happen. The calculator ensures you never risk too much again. Together, they skyrocket your weekly income results and protect your capital from the emotional errors that drain accounts. But before you go, here's a final thought that changes everything. The market doesn't care about your dreams. It doesn't know your fear. It simply moves. And you can either move with discipline or be moved by panic. Your financial future is not in some guru's hands, it's in yours. The weekly income you just mapped out, that's not a fantasy. It's a math problem you now know how to solve. Stillness in the face of red candles. Consistency when you'd rather quit. That's the edge. Most traders never discover it because they never pause long enough to let the blueprint sink in. But you've stayed. You've listened. That tells me you're different.